Hello, Oracles. Today I'm going to discuss my top 5 dividend ETFs. Now, none of this is any suggestions as that you should buy any of these ETFs, and none of this is financial advice. I'm not giving any buy, sell, or hold ratings on any of these ETFs whatsoever. I'm just going to discuss with you what my top 5 favorite that I personally own are. And I'm also not going to dive deep into them. I know many other channels do that, but I have mentioned it before. I want you guys to learn how to educate yourselves. I want you to learn how to do your own due diligence and research. I'll give a brief overview as far as what the ETFs are seeking to accomplish. I'll give a brief overview of their metrics and explain a little bit of those and the progress that we have seen with all of those. But otherwise, I'm not going to dive in. And I'll put in the description down below all the links to every one of these ETFs right to their direct site so you guys can go in and do your own due diligence and research. So I will provide that for you. But again, I'm just going to give you guys a brief overview today of what my top 5 ETFs are. And there are many other ETFs out there, some that are performing better than the ones that I own. I'm constantly looking for new ones as well. So if you guys have any ideas or any ETFs that you own, please share them in the comments down below. Now, yesterday I did release my spreadsheet to all of my members and patrons. It is going to be a live updated spreadsheet. All you need to do is just click on the link. I will give you guys access to it, and you guys can follow every move that I make at all times. And this is not just my stocks and ETFs and all of my moves there, but all of my finances, everything I'm doing for my money that's coming in to the money that I'm spending, so you guys can see what I do with my own budget in order to bring in as much money as possible to grow my net worth and my wealth to get myself to financial freedom. So I'm sharing that with all of you. If you guys are interested in becoming a member or a patron, just click that link down below. And also, if this is content that you guys like, please don't forget to hit that like button down below, subscribe to the channel as well. I'm going to be providing a lot more of this content going forward between dividends, entire stock market, finances, and everything. So please help me out and help the channel grow. All right, so moving on. Number 5 on my list is going to be SVOL. So SVOL is the Simplify Volatility Premium ETF. They have a 5-star Morningstar rating, and the Simplify Volatility Premium ETF, SVOL, seeks to provide investment results before fees and expenses that correspond to approximately 1/5 to 3/10 the inverse of the performance of the CBOE Volatility Index, or the VIX, short-term futures index, while also seeking to mitigate extreme volatility. Now, a concern some people have is we had seen one of these ETFs in the past, and when there was a massive volatility spike, we had seen that ETF completely collapse. So we saw a volatility spike come on August 5th, and because of what SVOL has done, they mitigated that risk significantly well. So looking at why, because when you go into their holdings, they hold a significant number of treasuries, and they don't play options with 100% of their holdings. They play options with a smaller percentage of their holdings so as to mitigate a lot of that downside risk. Now, their expense ratio is a bit on the higher side at 1.16%, but they are also paying out 16% in distribution. But it makes up for it with that return on a regular, steady basis. Monthly is what they pay out. And now they've only been around for a few years now, coming out in the middle of 2021. So their 5-year history is not very long, but you can see that they dipped down and then they've been basically trading sideways since 2023. So obviously 2022 was a rough year for everyone and every stock that was out there, especially the NASDAQ. But when you hit 2023, it's basically been flat. And quite honestly, when it comes to a stock or an ETF, they're going to be paying out dividend distribution of 16%. I'm not looking for equity appreciation on this. I'm looking for that consistent income that is coming in. And that is what they have been paying. And so when you look at their dividend history over the last 5 years, it has been steady right in the middle here. And it's dipped down a little bit, but it's basically been around 30 cents every single month for the last couple of years. But it's basically been around 30 cents for the last year, and we just now recently saw it dip down to 28 cents. So again, this is paying that 16% yield, and I don't always chase yield. Like I said, I like to go by strictly what the dollar amount is that they're paying out, because that's how I pay my bills, is by dollar amount. So I see this 28-cent dip here. I'm just going to kind of pay attention. Again, it's a significant payout, but I want to make sure that this is not going to be something consistent that we're going to see maybe every year they dip down 1 or 2 cents, because that is not going to be sustainable over the long term. So as of right now, it is my 5th favorite ETF, but I do want to make sure I keep an eye on it, just like I do with all of my other stocks and ETFs, to make sure that this is going to be sustainable in the long term. All right, number 4 on my list is JEPI, J-E-P-I. That is the JPMorgan Equity Premium Income ETF. This ETF has a 4-star Morningstar rating, and this ETF is also relatively new, coming out in May of 2020. So right in the middle of the COVID crash. So they've gone through the rebound from COVID. They've gone through the 2022 crash. So we will see what is going to be going on with this one. So the expense ratio on JEPI is 0.35%. And for a covered call ETF, that is actually not too bad. That's right about the industry standard. And JEPI seeks to deliver monthly distributable income and equity market exposure with less volatility. So what they do is write out of the money options on the S&P 500 index. And what the benefit of writing out of the money options is it will allow it to have equity appreciation. It will never appreciate as much as the S&P 500 will if the S&P 500 runs significantly, but it makes up for it with the income. So this is more for an income play rather than looking for an overall return or long-term gains play. This is something that you're going to do for income. And that's what I use it for. I'm using this one for income to be able to funnel that money into my other ETFs and stocks for long-term dividend growth and equity appreciation. And so the equities that are held here are, we've got Train Technologies, Meta Platforms, Progressive, Southern Company, AbbVie, MasterCard, Amazon, Microsoft, Lowe's, and ServiceNow. And as you can see here with total returns, it basically traces right along with the S&P 500. And yes, during a bull market or when the S&P 500 is going up, it is going to underperform. But as you can see here, when we saw that bear market of 2022, it was outperforming S&P 500 at a few timeframes over the course of that time. So if we are looking at a potential recession coming along in the next year or so, this could be a viable play that could outperform the S&P 500. And then, of course, we got to the point where we've been running since last October, and the S&P 500 is going to outperform. And now you look at the dividend payouts, and because it's a covered call ETF, they are a bit scattered all over the place. So if you're looking for extremely consistent income, it's not going to be there, but it is going to give you some income. And the volatility is going to dictate if you're going to be getting more or less of a payout. So again, you're looking at 2022. Bear markets tend to be more volatile. So again, if we're going into a recession, we can expect more volatility. And guess what? Those payouts during that time were higher. Now, why is that beneficial? That's beneficial because guess when you want to buy? When the stock market is low. So if you're getting a higher payout from an ETF during a time when the entire stock market is suppressed, guess what? You're going to be buying a lot more for a lot less, and you have more income coming in to do that. This is why this is my number 4 ETF, because it's going to be providing me significantly more income during times where I want to have significantly more income to purchase stocks that are suppressed. All right, number 3 on my list, DGRO. That's the iShares Core Dividend Growth ETF. This ETF has an expense ratio of 0.08%, so very negligible. So it's very inexpensive to have this. And the investment objective for DGRO is seeking to track the investment results of an index composed of U.S. equities with a history of consistent growing dividends. So this one here is focused on dividend growth in the long term. So when we look at the holdings here, we've got ExxonMobil, Microsoft, Apple, JPMorgan, Johnson & Johnson, Chevron, AbbVie, Broadcom, Home Depot, and Procter & Gamble as their top 10. And again, comparing this one to the S&P 500, it tracks it very, very closely here, slightly underperforming the S&P 500 in total returns. But again, this is something I'm looking for as an income play and not for actual equity appreciation. So when I'm looking for income, I'm going to look at their dividend growth history. And again, since 2014, when they started paying out, they have been growing their dividends steadily every single year. And so from 2021 paying $1.17 to $1.32 in 2022. These are just growing consistently year over year. And that's what I'm looking for is, again, I talk about it all the time of you've got to be able to outpace inflation when it comes to your income. If your job is going to be giving you maybe a 3 or 4% raise, but you've got dividends that are going to give you an 8 to 10% raise every single year, which one would you rather have? And yes, maybe it's going to be paying you less right now, but in the long run, it is going to end up paying you more, and it will be growing significantly more over time as well. And one thing I want you guys to notice as well when it comes to these ETFs, and the last 3 that we're going to talk about are going to be all the same, is they pay out quarterly, and on a quarterly basis, it may vary from quarter to quarter when it comes to their payouts. But when you look at them year over year is what you want to look at. So for instance, if you're looking at Q3 of 2022, they paid out 34 cents. Q3 of 2023, they paid out 39 cents. Q3 of 2024, they paid out 40 cents. So look at the year over year based on the quarter, and that's how you'll see how the dividend is growing, as we saw from that last chart. And so this one here, along with the last two I'm going to mention, are the ones where I'm taking the money from SVOL and JEPI and putting that money into these three ETFs, along with many other stocks and ETFs as well, because this is where I want my money in the long term. So I'm using those other two as income to purchase these other ETFs that are out there for that long-term growth. All right, number 2 on my list, and I had made a video about this the other day as they had just announced a 3-for-1 split. Super excited about that. Now, this one here has an expense ratio of 0.06%, so slightly less than DGRO, so even less expensive, which is great. And the objective of SCHD is to track as closely as possible, before fees and expenses, the total return of the Dow Jones US Dividend 100 Index. So again, trying to keep myself diversified. DGRO is a little bit more closer to the S&P 500. SCHD is to the Dow Jones. And there's a lot of different websites that do fund overlaps, and you guys can definitely check all those to make sure you're not over diversified, or maybe you have your money into 3 or 4 different funds that are overlapped. And I still do. I'm looking to thin some of mine out, and I'll make a video about that in the future. But there's a way you can take a look at the overlaps, just to make sure you are diversified, but not over diversified. And it's good to pay attention to that. So looking at the holdings that we have here, we've got Home Depot, Verizon, and I'm not a huge fan of Verizon, but it pays a good dividend right now, but I have a feeling they're going to end up falling off of this list at some point. BlackRock, Cisco, Texas Instruments, Pfizer, Lockheed Martin, Bristol Myers Squibb, Chevron, and Coca-Cola. And some of these I do own individual stocks of, like Home Depot and Coca-Cola I own individually, but that's just for a little extra exposure to those because I do like them. But again, just the ETF itself, especially for someone new getting into investing, I highly recommend getting into ETFs first. It's going to give you a blanket, broad market base of different companies that are out there, and you're still going to have your toes in the water to invest. And then from there, you can learn for yourself how to read valuation models, how to read earnings, listen to earnings calls, what they all mean, and then you can do your own due diligence or research from an educated standpoint on your own to then invest into individual companies if you so choose. And now comparing SCHD to the S&P 500, you can see that yes, it definitely underperforms the S&P 500. We know that, the Dow Jones itself wasn't doing very well. Usually the NASDAQ runs a lot faster and higher than companies in the Dow Jones and value plays. And SCHD is more of a value-oriented ETF. So it is definitely going to underperform when it comes to actual equity appreciation. But again, this is something I'm looking for income for the future. And so again, when you're looking at that dividend growth, again, this is that income and those raises every single year. Ever since 2013, they've been going up and up and up. And again, going from 256 to 266. And it looks like this year they're going to be going up even more. They had a rebalancing back in March. They do a full rebalancing every single year. And a lot of people were upset because like AVGO, Broadcom ended up getting knocked out. But all of a sudden, those dividend returns came in much higher than expected. Shocked a lot of people. But again, that's what the strategy of this ETF is. And again, when you're looking at the payouts on a quarterly basis, they will fluctuate. But as I had mentioned before, when you look at them as a year-over-year basis as a quarter, you're looking at Q3 of 2022 of 64 cents, Q3 of 2023 at 65 cents, and then Q3 of 2024 at 75 cents. Massive income growth coming from this ETF. And that is what I'm in this for. I'm not in it for the equity appreciation. I am in this for that income growth. And that is what is going to help lead me to early retirement. Or at least that's what the plan is. And my number one ETF is VOO, the Vanguard S&P 500 ETF. The actual benchmark that everyone compares every other stock and ETF to. So why not make it my number one? Because it is going to be the industry standard. So here they have an expense ratio of 0.03%, basically negligible. And basically this is giving you exposure to the top 500 companies in the US. So this is why, as far as a new investor goes, if nothing else, just throw some money into the VOO. It has historically always gone up in the long term. Yes, you may have fluctuations in the near term, but in the long term, it always has gone up. That is not to guarantee that it will continue to go up forever. However, historically, it always has. And the top 10 holdings are Apple, Microsoft, Nvidia, Amazon, Facebook, Alphabet, otherwise known as Google, Berkshire Hathaway, Class C Alphabet, Eli Lilly, and Broadcom. And so again, this here is the exposure. So while maybe the other ETFs that I have underperformed the S&P 500, I have the S&P 500, so my portfolio itself is going to be tracking right along with it. and I have double exposure to a lot of these companies in a lot of areas, thereby allowing my portfolio to grow, and I'm not underexposed when it comes to technology. And now breaking it down by sector, some people aren't a huge fan of the fact that the S&P 500 is so heavily weighted in technology. 31% is information technology. You've got 13% in financials and 12% in healthcare. And as you would expect when you're looking at the VOO compared to the S&P 500, which you would think that they are the same, but when you've got to factor in a total return because VOO does pay out dividends, very small, but they do pay out dividends, it's outperforming the S&P 500 slightly. So again, you're going to get the exact same equity appreciation on it because it's tracking it, but you get those little dividend payouts, which are a nice little bonus. Now, VOO isn't going to be paying out dividends that are going to be anything to write home about, but it's that nice little extra padded cash that just helps your portfolio grow over the long term. And so again, looking at that dividend growth over the last 10 years, it actually did see a little dip going from 2018 into 2019, and then it went up from there. So we know that 2018 did have a bit of a rough period at the end of the year there, and then from there we just keep on going up. And again, looking at the dividend history over time on a quarter-to-quarter basis, continually going up with those quarterly fluctuations, but again, on average, continuing to go up year over year. So there it is. There are my top 5 dividend ETFs for you guys. Again, do your own due diligence and research to see if they are right for you. But for somebody who is a newer and a beginning investor, this could be a very good place to start, especially when you're looking at the likes of VOO, SCHD, and DGRO. JEPI and SVOL, definitely do a little more research on for yourself to make sure that they are right for you because they are more suited towards just income plays themselves, and there's a little more volatility and risk involved with them, but the other 3 are relatively stable. Again, I'm not suggesting that you go out and purchase them, but what I'm recommending is that if you are interested in investing, do some research on them yourself. Check the links in the description down below. Check out the sites. If they seem like they are right for you, then take the next step from there and begin your investment journey. Because investing starts when you start investing. It's never too early and it's never too late. The best time to invest is right now. So always get out there and do that because that's how you're going to grow your wealth over time. Compound interest in the long term is going to pay off massively, as you can see with Warren Buffett and what he has done with Berkshire Hathaway and his entire net worth. So that's all I've got for you guys today. Let me know your thoughts and comments below. Any questions you may have, any other ETFs that you may have in your portfolio as well. There's a lot of other great ones out there as well. And there's a lot of different companies out there who have very similar products to each other that are similar to the ones that I had mentioned. So you guys can mention those down in the comments below and maybe you like one over the other. Thank you guys so much for watching. I appreciate all of your support. Have a great one.